optimism, sober optimism, is needed more than ever now to invest in the future, even as we face challenges across the globe. Thus, our next executive panel, Global Investment Slowdown, Navigating Promising Sectors. This session will explore how VC funds are navigating the global slowdown in funding, and it will highlight some of the most resilient sectors, emerging technologies, and key trends that are shaping investment decisions in today's challenging landscapes. Our moderator for this next panel is none other than Iman Larash, a senior news presenter at Sky News Arabia. Please join me in welcoming to the stage Iman Larash.
Thank you. Thank you so much. And I would like to thank you, everyone, for being here with us and spending your precious time with us. Today, we're talking about VCs, as mentioned. And I believe that whenever we hear VC or venture capitals, the first thing that crosses our mind is risk. Because VCs like risks. They are all about risks. Because otherwise, every startup business will just go to the bank and get a loan. So otherwise, we need to know how it works, how decisions are made, especially in this troubled world we're living in, marked by growth and investment slowdown. Also, we want to know the trends nowadays in the markets globally. So, no further delays, because we want to hear it from the experts themselves. So, join me, please, welcoming our speakers of this panel. We have with us today Mr. Sharif Al-Badawi, CEO of Dubai Future District Fund. Welcome. Hello. We have also Dr. Chiang Bing, Founding Dean and Professor of Chinese Business and Globalization at Chung Kong Graduate School of Business, China. Thank you. And please welcome Abdulrahman Al-Jifri, partner at 500 KSA. So, good morning.
Good morning.
Thank you so much for being with us. I'm going to start with you, Mr. Sharif Al-Badawi, because you came to MENA region to somehow make a difference.
Hoping to, yes.
Yeah. So how's the progress in general? Because here we're noticing like local markets, diverse, trying to build their own ecosystem, healthy ecosystems. And also you, based on your background in Silicon Valley, you're trying to fill this gap between MENA and Silicon Valley. How's, in general, the VC landscape in the region and the progress, Mark?
Thank you, Iman. So, yes, I did move from California. I was born and raised there, so I worked in technology for 25 years. And then I realized that through a series of mentorship trips to the Middle East, I realized that there's an entrepreneurship ecosystem brewing or in the making starting. This was around 2014-15, and it had already started maybe 5 years before that. So when I started coming in here, I said, you know, there's a lack of informed type of capital, the right kind of capital needed for startups, and mentorship and all the other kind of cross-pollination of expertise and experience. So I took several other trips out here at the time and realized that the job was very different than the job in Silicon Valley. And one realization is that entrepreneurship can happen anywhere in the world now, very different than it was maybe 20, 30 years ago. And the other realization is that the job here is you're talking to the governments every day, whereas in Silicon Valley, that wasn't anything I had experienced before. So whether it was in Morocco or Oman or Jordan or here, we were constantly talking with the government on how to do transformation and innovation and technology and to further that. So just to give you a couple highlights of like what changed or what's happened so far in the progress. From those days, we were clocking about $200 million to $400 million in total invested in MENA through venture capital into startups. That number reached a $1 billion mark before COVID. And now, if you look at the sort of wider geography that we're counting the data in, we've hit $2 billion and $4 billion, including sub-Saharan Africa. Now, that has now retreated a bit in the last 18 months. We've come back down slightly below $2 billion. But that's okay. I mean, the whole world has slowed down. It's called the VC winter these days. But then under the amount of capital deployed, we also saw that the trajectory of exits has increased in size and frequency over the last 10 years. That means the exits, the startups are providing liquidity then to their investors. And the model works really well because everybody in a startup gets equity in the company. So it really democratizes access to status changes. So social economic fabric can actually change from this. In the US, Hillary Clinton was quoted saying 90% of net new jobs come from SMEs and startups. We believe that can happen in emerging markets as well. We're seeing it happen everywhere. So Southeast Asia might be 5 to 7 years ahead of MENA, but we all have the same challenges. We're a multi-country region, so very different than a homogeneous India or China or US. And so the challenges involve the borders. And just in the last few years, globalization has somewhat retreated. And borders are going up higher. Data needs to be in country, healthcare needs to be in country, supply chain in country, and very similar capital deployment, unfortunately, has started to become developmental in that way in country. So hopefully that will break apart again soon and flatten again soon, because it's a struggle for startups to be able to hire people across borders, get visas and licenses and regulatory frameworks across borders, and customs and tariffs and all the other things that come with borders. So startups are technology companies, essentially, and they cannot see borders. And none of the countries in these regions by themselves has all the value that is needed to grow to, let's say, unicorn status, as Dr. Bing likes to mention. So, but you know, they cannot grow that big on their own in any of the particular countries. Egypt has a very large market. Saudi has an affluent purchasing power market and capital. UAE has connectivity and infrastructure. So each contributes something to the ecosystem. But when you take the story as a whole, that value proposition is extremely attractive. It's almost 500 million people, similar culture.
You mentioned UAE, KSA, for example, but can we say it's the same progress in a GCC, non-GCC in MENA or Middle East, for example, versus North Africa?
I would say it is similar progress. I mean, you hear more noise in Saudi and UAE and Egypt. Those are the three primary markets in the Arab-speaking world. However, we've seen very big companies come out and successful exits come out of Kuwait, out of Bahrain, and out of some of the other countries as well.
Okay. So before stopping with you, Dr. Chang, about China, let me stay in the region, MENA, and especially KSA with you, Mr. Abdulrahman. KSA is becoming a major, great player, competitor in the VC in the region, and it's working on building its own ecosystem. How is it going, and what are also the challenges to overcome yet?
I mean, the region's developed quite a bit. I'm very proud of the whole progress that we've seen, both in terms of being more open. So Sharif mentioned the challenge of borders. Entrepreneurs target opportunity. They don't want to worry about borders. It's just paperwork for them, right? So anything that brings that down, that makes it a little bit more open, has an insurmountable effect on the ecosystem as a whole. And we're seeing that. Saudi's becoming more open. It's easier to get visas. People can come in and out. And that has been the biggest unlock in terms of giving more flexibility to founders to choose how they design their own lives. It's hard enough to start a company and then put additional restrictions on, you know, founder here, founder there, and put additional qualifiers there, right? They're already building the ecosystem in the region, and Saudi's been a lot more open to that. The sovereigns have not demanded that all the capital that's going into venture capital stays in Saudi. No, these funds are deploying across MENA. And that's been a huge unlock to get more and more capital. So we saw last year almost $1 billion in venture capital deployed as per the Saudi Venture Capital Report. And obviously we're getting a small retreat this year, but it's to be expected. investors in the region are global investors. They have access to asset classes across the whole world. So they restabilize. In terms of challenges, I would say LP education is one thing that I think is ignored, right? Yes, the governments have played an incredible role in stimulating the ecosystem. We have worked, I've seen a lot of work on GPs, emerging managers, a lot of work on founders and unlocking and removing obstacles from that. But you can't sustain an ecosystem just from sovereign funds. It has to also come in from the private capital, education, maturity there is something that I'm excited to see, as well as more interest in technology broadly, right? I think in an interest to kind of mimic what we've seen globally of, oh, this model works, we've wanted to race and get there really quickly. Whereas every single ecosystem has its unique advantages and disadvantages and should be allowed to develop in its own way. So it can't just be, this is the Silicon Valley playbook, let me recreate it. No, we all have to kind of find our own unique angle and allow it to organically materialize.
Thank you so much for this, pointing this. Moving east to China with you, Dr. Chang. Of course, depending on last reports that China VC ecosystem is facing some challenges, especially in 2023, because of like geopolitical tensions, because of growth slowdown, etc. How do you see it from your point of view, but also to get the full image? We want to understand the China versus America or US. How is it working, given the first is like China is a disruption-driven economy, and the second one is an innovation-driven economy?
Morning, everyone. Thank you for having me here.
Thank you.
And in order to understand China's economy, probably we may need a different angle. First, the fact is, if you look at the economy since 1979, China, US contributed 44% global economic growth. You look at economic growth since 2013 to 2021, China contributed 38.6%, US 18.6%, G7 27%. China must have done something right, for that kind of success, I argue the US model is predominantly innovation-driven. US is leading in many aspects in that aspect. But for China, I argue the very success of China is predominantly disruption-driven. China not atop in innovation yet. China's catching up. Alternative energy, e-vehicles, all of that. G5. But in the past, is imitation is wise to imitate, not so wise to innovate. You look at all the successful companies, the key element of success is generating disruption. I have the data to illustrate my point, And for 2001, China only had 11 companies as Fortune Global. As of today, 129. And you look at the billionaire on the Forbes list, China had one to begin with. Today, 495. Unicorns, China has 173, second only to the United States. You look at the newly generated global Fortune 500 companies, newly minted billionaires, China has been number one for the past 20 years. And you look at the ranking of rich people in China. You look at the 10 richest people in China in 2010, as 10 richest people today, only Pony Ma stay as a top 10 for the past 13 years, All 9 people in the 2010 disappeared from the list, That's what I call the economic disruption. So I might argue the US model is more innovation-driven. The Chinese model, more disruption-driven. Actually, the Chinese way, some of the elements can be applied easily to India. You see flood of investment from China to India. And then sometimes it just copy the business model in China. It's a huge success. You can plan some of the business model in China to Indonesia as well. Not every country can come up with Google, Amazon. So US model has a uniqueness, but its relevance for other countries may be limited. And innovation, disruption, two different things. Japan, EU, excellent in innovations. But you look at the disruption for Japan, for example, not doing well for the past 20 years. How many new global companies generated? How many newly minted billionaires? Unicorn, Japan only has 7. Korea has 14. Korea is far ahead of Japan in that regard. Italy, number 8 economy globally. No single unicorn till a few months ago. So innovations, disruptions, different stories. Do not look down on disruption. Do not feel bad about being an imitator. Sometimes it's wise to imitate. Make a $10 billion US dollar first, then spend $1 billion in innovation. If you fail, you still have $9 billion US dollar in your pocket. Okay, that's my advice. Thank you. Thank you so much.
Thank you so much. I don't know if Mr. Sharif will agree with you about this, about innovation versus disruption. But also, I want to ask you about the VCs trends in the region, because most of them here, they tend to into fintech and e-commerce in general, which is good. But how to get to the next level when we see like high tech and also vertical VCs, multi-stage funding, etc.?
I don't know how you set that question up so perfectly, because it is exactly what I wanted to say next and addresses sort of the question of whether I agree with Dr. Bing. So thank you. That was like a perfect setup. So the Dubai Future District Fund is aiming to deploy, so we deploy 50% of our capital into the VC funds in the region. And yes, most of the VC funds in the region are seed to A stage and sector agnostic, because it's a greenfield and it's a new ecosystem. And a lot of the basic services that exist in other markets didn't exist here yet. So why would we reinvent the wheel, right? Just go find the things that work and imitate. So I think there is always a place for that strategy of imitate, and we're doing that here. Now, some people might say, well, that's not innovation. But the innovation turns out to be in the localization of that service or product. So yes, we're going to take the same food delivery that the US had, but it doesn't work exactly the same here. And it's the entrepreneurs that are local here that can figure out that localization. So there is some innovation to imitation. And then secondly, as a government, we're trying to be thoughtful or conscious about when are we cannibalizing the efforts of the private sector and the VCs on the ground versus complementing. And of course, we want to be complementing. So in our direct investment checks, we try not to invest in the things that are very low-hanging fruit for the VCs, because they're already investing in those things. They're sector agnostic. They invest in media and e-commerce and on-demand and all that. Now, we as a fund do not invest in commerce or commerce enablement. We don't invest in marketplaces, and we don't invest in tech-enabled startups. So for us, they have to actually be tech startups, core tech, and we're leaning as much as we can towards deeper tech. So we do future of finance, which is fintech, regtech, legal tech, because those are sort of essentials of the ecosystem. And yes, the private VCs are also interested in those. But then we go for medium hanging fruit, because we're not yet ready as an ecosystem to fully dive into deep tech, although we'd love to. But we understand that there are components of the foundation of deeper tech environments that we just don't have yet. And there are sister organizations in the Dubai government and Abu Dhabi and Riyadh or Jeddah working on an R&D strategy to increase R&D in the region and to make it acceptable to fail or to not have pressure on a timeline, just to work on a problem and give them the space to work on that problem. No commercial expectation out of it. That's how R&D is supposed to happen. So we're building university labs in the universities in the UAE. KAUST is a great example out of Saudi that has actually commercialized some of the innovations coming out of there, some of the IP. And then there's the grant component that is missing. We need the de-risking capital before the venture capital. And then alongside the venture capital, we need the project financing and the debt vehicles in order to do some of the deeper tech, because the fact is deeper tech either requires longer R&D cycles than a normal startup or higher CapEx costs than a normal startup, software-based startup. So even AI, which is completely software based on hardware, is an innovation that's going to require CapEx. Everything in the deeper tech of healthcare or of food tech, meaning food sustainability, agri-tech, is going to require CapEx spending. And venture capital is just not the right kind of capital for that. So we need to pair up with the other types of capital, and we're building those kinds of things now.
Thank you so much. How about you, Mr. Abdulrahman, how you see the trends nowadays in the region? Given the growth or investment slowdown in general, globally, not also only in MENA region, given the lack of private sector, individuals' involvement in funding, and also people, entrepreneurs, also fascinated by the trends and glamorous sectors, instead, somehow, I don't know if I'm right, meaningful businesses.
Yeah, I mean, Sharif set it up nicely in terms of low-hanging fruit. It's exactly the image I had in my mind. There's a lot of obvious services that people need. They expect. They've grown to be accommodating of, oh, I want this, I want this. And obviously, COVID accelerated a big chunk in terms of being comfortable ordering, spending, buying, and expecting that level of service to get there, which means that they were just more receptive. Now that we've gone past this point for a lot of different sectors, it's time to look at the others. Fintech, for example, is one that, yes, has received a lot of funding, but it's still relatively fintech light. It's the core top-level banking services. There's still more in-depth stuff that's going to be built in. There's not obvious stuff. Because that's opened up recently, given the regulatory climate, open banking, a lot of things are moving that are allowing them to become more creative. So that's become the next unlock. What does the opportunity lie? Now, the danger of what is now possible, that wasn't possible before because of tech, is that some people want to chase the trend, right? Entrepreneurs are excitable. They want the new thing. And that new thing right now happens to be AI. I warn my team jokingly every now and then. I'm like, the threat to venture capital isn't AI as a core technology. It's AI-generated applications. I'm expecting a lot of GPT-4 is out there in these emails and pitch decks and investment memos. But what's happening is that the companies that specialize in AI that aren't tech-enabled but are actual real core tech are the ones that are coming with data strategies. And that's where policy comes in. That's where data sovereignty comes in, especially when we talk about sectors that are now up and coming. We're looking at huge growth in enterprise software. We're looking at huge growth in healthcare.
I think you need another mic, I believe, right? Because it's
All right,
reserved.
I'll try. There's a bit of a fluctuation. So if we're seeing all this excitement about enterprises and healthcare, that basically means that data sovereignty and privacy becomes a key factor in the discussion. How can we be the leader? And that's what's being discussed right now. AI is embedded in every single sector, and those that have the deep sector expertise is going to be the next thing. The last trend that I'm super excited about is the kind of talent that startups are attracting. So now is when we're seeing third-time founders, second-time founders starting their companies, people who have been a decade in the corporate sector, who have experience in banking, experience in healthcare, experience in corporates, who know deeply what the problem is and how it can be resolved, which is resulting in the deeper layer of solutions that are spreading across the region.
It seems that Dr. Chang agrees with you. How about the situation in China, especially that China has its own strategy to be like an innovation powerhouse by 2050. How is it going? Giving like the role of imitation and innovation. You spoke about it earlier.
You have to learn how to walk before you learn how to run. That's the case for every nation. When US catching up with UK, imitation strategy, the same thing. For the Japanese, for the Koreans, and for the Chinese, no exception. So we learn how to walk. Next round, we learn how to run. But it depends on the sector. In China, there's about 30 sectors meant to be deregulated. 9 sectors monopolized by state-owned enterprise central government. 7 sectors pretty much predominant to the SOEs. So China can grow its economy by deregulation. For those sectors, deregulation will provide a beautiful opportunity for imitation, not innovation. Be a copycat. Become a billionaire first. Let's think about innovation. For the sectors are very competitive. like BYD's here, globally competitive. If you don't innovate, you have no future. You don't need the pressure on them. They know what to do. So it depends on the sector. And for our school, we've been promoting next generation unicorns. Since 2015, we have a program targeting unicorns. By 2021, we had 236 founder of unicorns in the program. That's the biggest by far. For the future, tech, deep tech, will be a key source of disruption, not the only source. So that's the reason why we work with Berkeley Engineering. Early November, deep tech unicorn. Mid-December, Stanford Engineering, deep tech unicorn. Columbia University, next May, May 12 something. Whole university, again, deep tech unicorn. Life science, healthcare, UC San Diego, biotech. Johns Hopkins, October next year, global unicorn life science. So tech, innovation, truly global. There's no way it's going to be Chinese innovation, American innovation. We have to innovate together, including GCC. That's the way it's going to be, whether market-wise, innovation-wise. So that's our strategy for what I call the next generation unicorns. Social purpose, global responsibility, long-term perspective. Next generation unicorn, truly global. Look at the geopolitics today. Many of the issues truly global in nature. I hope there'll be more business that truly global in responsibility, working together to address some of the most pressing global issues. We cannot leave all the problem to the politicians. We got to do something. Thank you.
Thank you so much. But I believe that Mr. Al-Badawi disagrees about the unicorns, and because we were discussing before, and I believe that you see it as overrated. I don't know about it, but I want also to ask you about the future and preparing the future on how to predict effectively the future of economy. How is it going to be in 10, 20, 30 years to be prepared to it?
So on the first part of the question, it's not that I have anything against unicorns. It's just I think some of these mics are not working well. But I don't have anything against unicorns, but I think that it may be misguided for governments to use them as KPIs, reaching X number of unicorns, because as we probably or hopefully have learned in the last few years, is that raising more money or increasing your valuation isn't an indicator or corollary to success. In fact, in the last few years, it was actually an anti-corollary. Right, so I don't think that that's something we should all be striving for. Now, from a fund manager perspective, as a VC who invests in the startups, I've told founders before, keep your valuations low. Raise only what you need when you need it. Because we've had exits, 2 parallel exits, where one exited under $10 million, and the founder became a millionaire. We got a 7x return on our investment. One exited for $120 million in exactly the same 9-month period, and we got 1.9x, and the founders are still working for the acquirer, and they're not millionaires. So it's not what it seems to be from the outside. Now, from a portfolio construction perspective that fund managers have to follow, in order to get the exit to return your investors their money, you need to get 2 to 3x on the fund, which is essentially you need to believe every investment that you're investing in needs to get a 10 to 20x return, because 9 out of 10 of them are going to go to zero. So one of them is going to return to fund, and you'll finally get your 2 to 3x. Now, there's a lot of math, but just to simplify it, when you invest at a company at too high of a valuation, let's say you come in the seed round at $20 million instead of a $5 to $10 million round, you just lost 4x return, and that's going to make it that much harder for you in the future to be able to get that return on that investment, especially if more money is being piled on, because these founders were raising money to get to unicorn status, not to create sustainable businesses. They weren't being responsible. Neither were the investors, honestly. They weren't being responsible either. So just piling on layers and layers of capital, each of those layers has structure in them, which is liquidation preferences, other kinds of terms in there that will defeat the type of return that the previous investors are getting, and then eventually the founders. So in some of the unicorns that you've seen in the news over the last year, sometimes the founders will actually not make any money. And the early investors, there was one that IPO'd recently, InstaShop, that didn't, or Instacart is the US one. I'm getting used to here. But the reports were showing that the seed and Series A investors are the only ones that made money. And the rest of them didn't make money. So just targeting unicorns blindly, I think, is misguided. Now, on the other part of your question, which...
Future? How to forecast effectively
Yeah, the 30-year future,
of
which
economy.
is very prescient, because our strategy is built on a 30-year future. Very uniquely, the fund is structured as an evergreen fund. And it's very rare to see early-stage venture capital structured as evergreen, but it's exactly what Dr. Cheng was saying. We're long-term investors. We're patient capital. We're a government-backed fund, so essentially our return horizon is forever. It's not the 10-year term fund that a VC usually is. So VCs are usually 10-year term funds. That forces them to behave in a way to optimize for the 10 years to return the capital to their investors. But when you break that open in an evergreen fund, we no longer have that pressure. So A, we can hold on to investments longer if we feel the value creation is a longer term value creation, something sustainable and responsible, right? The other part of it is that we can then hold on to public equities after exits. We don't have to divest from those companies right away. And so there are a number of things. And we define that, I'll say the last comment is that we define that based on the 2050 reports. So if you read any of them, there's about 115 2050 reports out there from PwC, World Bank, and many others. All of them point to the same trends happening global economies in the 30-year period. So we defined our future economies thesis based on those things, and they happen to be SDG, mostly SDG related. And in the risk section, I think this is very important to state based on what we were talking about borders,
Yes.
is in the risk section of these reports, the number one risk is protectionism.
Yes.
Meaning the borders going up, globalization retreating, all those things I mentioned and were mentioned by my fellow panelists, is the biggest risk to our economies in the future. These borders need to go down, we need to play together. That is the future. If you think about climate alone, climate and food and water and energy, all of those are going to be different in the next 30 years. There's going to be one country that has the resources, but it's supplying it to other countries, not using it, and vice versa. It's going to be a bartering system. So we're going to go back to the old Bedouin way of trade, which is going to be great.
Thank you so much. Unfortunately, our time is up. So I would like to thank all of you, Mr. Sharif Al-Badawi, CEO of Dubai Future District Fund. Thank you so much, Dr. Chiang Bing, Founding Dean and Professor of Chinese Business and Globalization at Chung Kong Graduate School of Business, China. And thank you so much, Mr. Abdurrahman Al-Jifri, Partner at 500 Global KSA. Thank you so much, and thank you for being with us.
Thank you, Iman.
For your time.